Here's a question for you. What happens when a company beats Wall Street on both revenue and earnings, raises its full-year guidance, and increases its AI revenue target by 50%, and the stock still falls 14% in a single night? That is not a hypothetical. That is exactly what happened to ServiceNow on April 22nd, 2026, the day the company reported its first quarter results.
And the irony runs deep. ServiceNow is one of the most consistently executing companies in enterprise software. 7 consecutive quarters of revenue beats heading into this one. But the market is not trading on what ServiceNow did in Q1. It is trading on what the market is afraid AI will do to ServiceNow's business model over the next 3 years.
Revenue of $3.77 billion versus the $3.74 billion estimate. Non-GAAP earnings per share of 97 cents versus the 95-cent estimate. Guidance raised by $205 million for the full year, and 27 of 31 analysts covering the stock still rated a buy. Yet the stock opened the next morning at $89, near a 52-week low.
What you are seeing is a market that has repriced the AI risk premium for enterprise software platforms. The question investors are asking is not whether ServiceNow is executing today. It clearly is. The question is whether the platform matters in a world where AI agents do the work that humans used to do, and whether ServiceNow benefits from that shift or gets disrupted by it.
That is the tension at the heart of this episode. A world-class SaaS platform with an outstanding fundamental track record, trading at its lowest valuation in years, with the CEO buying stock in the open market, and a genuine debate about whether the AI wave lifts this ship or swamps it. Let us dig in. Let us set the stage. ServiceNow is the company behind the Now platform, a cloud-based system that digitizes and automates enterprise workflows. Think of every time a company's IT help desk resolves a support ticket, an HR department processes an employee onboarding request, or a security team responds to a cyber alert. ServiceNow is the platform running underneath those processes for more than 8,100 enterprise customers worldwide.
The business model is almost entirely subscription-based. 97% of revenue comes from multi-year contracts, and ServiceNow has a 97% customer renewal rate, which is exceptional even by SaaS standards. Once a company builds its critical workflows on the Now platform, replacing it is not just difficult, it is genuinely risky. Enterprises have thousands of custom automations embedded in ServiceNow that represent years of business logic.
The land and expand motion is central to how ServiceNow grows. A customer starts with IT service management, the help desk tools, and then expands into HR service delivery, customer service management, security operations, finance workflows, and now AI-powered automation across all of those categories. The company has 630 customers spending more than $5 million annually in contract value. That is the premium customer tier, and it is growing rapidly.
For context on scale, ServiceNow processes an estimated 7 trillion enterprise transactions annually across its platform. That is not just software utilization. That is a proprietary data layer that makes ServiceNow's AI meaningfully more accurate than generic large language models applied to enterprise tasks. The platform knows the context of every IT ticket, every HR case, every security incident. That context is the moat.
In 2026, ServiceNow is repositioning itself as what McDermott calls the AI control tower for enterprise reinvention. Its Now Assist generative AI suite is embedded across every product. The company just closed the Armis Security acquisition, a $2 billion deal bringing AI-powered cybersecurity asset management into the platform. And the MoveWorks acquisition, focused on employee AI assistance, was already integrated in under 3 weeks and closed 6 deals above $1 million.
The competitive landscape is complex. Salesforce competes on the customer-facing side. Workday competes in HR workflows. Microsoft competes everywhere with its Power Platform and Copilot tools bundled inside Office 365. But ServiceNow's argument is that it is the neutral layer sitting between all those applications, the platform that connects the systems enterprises already have and makes them smarter through AI orchestration.
85% of the Fortune 500 are ServiceNow customers. That is not a startup winning incremental deals. That is a platform that has become infrastructure for the largest organizations in the world. The company is headquartered in Santa Clara, California, employs about 33,000 people, and has been building this platform since 2004. Now let us talk about the CEO, because Bill McDermott is a genuinely important part of this story. McDermott has been chairman and CEO of ServiceNow since November 2019, succeeding John Donahoe, who left for Nike. Before ServiceNow, McDermott ran SAP as its first American CEO from 2014 to 2019, and grew SAP's market cap from $39 billion to $163 billion. He is one of the most accomplished large enterprise software executives in the industry.
The Street views McDermott as one of enterprise software's most effective evangelists, relentlessly energetic, customer-obsessed, and skilled at translating technical platform capabilities into CEO-level business value narratives. His AI messaging has been particularly effective in 2026. What makes Q1 2026 notable from a leadership standpoint is that McDermott made an open market stock purchase of approximately $3 million during the quarter. CEOs at large-cap software companies almost never buy stock in the open market. It is a meaningful signal of personal conviction.
Let me dig into the financials. ServiceNow is a premium valuation SaaS company, and the stock has come down sharply. At $89 per share, the market cap is approximately $92 billion. That puts the trailing price-to-earnings ratio at 49 times. The price-to-sales ratio is 6.6 times. The price-to-book is 7.9 times. And the EV to EBITDA is approximately 19 times.
To put those multiples in context, ServiceNow is still a premium-valued software company, but these are the lowest valuation multiples ServiceNow has traded at in over 3 years. The stock peaked above $211 in 2025. At $89, it has retraced more than 57% from that peak and is down 34% year-to-date. The market has done a lot of derating work on this name already.
On revenue, ServiceNow generated $3.77 billion in Q1 2026, up 22.1% year-over-year. Trailing 12-month revenue is approximately $13.96 billion. The company has been growing at roughly 20 to 22% consistently, and the Q1 acceleration above the $13.96 billion run rate confirms that growth trajectory is holding.
The subscription revenue metric is particularly important here. That was $3.67 billion in Q1, up 22% year-over-year. Subscription revenue is the core of the business model. The current remaining performance obligation, CRPO, grew 22.5% to $12.6 billion. That is contracted revenue expected to be recognized over the next 12 months, and it is the best leading indicator of where ServiceNow's revenue is heading.
On margins, ServiceNow's GAAP gross margin came in at 75.1% in Q1 2026. The GAAP operating margin was 13.3%. Net margin was 12.4%. But the number Wall Street cares most about for software companies is the non-GAAP operating margin, which strips out stock-based compensation, and that came in at 32%, 50 basis points above the company's own guidance.
The gap between GAAP and non-GAAP for ServiceNow is substantial because the company has significant stock-based compensation expense, about $700 million in a single quarter. That is a real cost that dilutes shareholders, and it is worth keeping in mind when comparing the GAAP and non-GAAP narratives. That said, the 32% non-GAAP operating margin is genuinely best in class for a company growing at 22% annually.
Cash flow is where ServiceNow truly shines. Operating cash flow on a trailing 12-month basis is $5.44 billion. Free cash flow is $4.63 billion, representing a 44% free cash flow margin in Q1. That is not a financial metric you expect from a company investing aggressively in AI. It means ServiceNow is funding its AI build-out from operations while still generating massive cash surplus.
The balance sheet tells a similar story. ServiceNow held $5.18 billion in cash and short-term investments at quarter end, against total debt of $2.43 billion. That is a net cash position of $2.75 billion. Return on equity was approximately 15%. There is one important caveat. The Armis acquisition, which closed on April 20th, was funded by a $4 billion term loan. That materially changes the debt picture post-quarter, but management indicated the term loan will be refinanced with long-term notes.
On the earnings per share, non-GAAP EPS of 97 cents beat the 95-cent estimate. GAAP EPS was 45 cents, reflecting those significant stock-based compensation charges. The forward price-to-earnings ratio on the FY 2026 analyst estimate of $4.21 is approximately 21 times, which is actually quite reasonable for a 22% grower with a 44% free cash flow margin.
ServiceNow pays no dividend and has not announced any buyback program. The company is deploying all capital into growth and acquisitions. Revenue is growing 22%, AI contract value is growing 50%, and management is guiding for 35% free cash flow margins for the full year. Overall, ServiceNow's financial health is strong, best-in-class cash generation, net cash position, and consistent execution against guidance.
The full-year guidance. Management raised subscription revenue guidance by $205 million to $15.735 to $15.775 billion, representing 22 to 22.5% growth. Non-GAAP operating margin for the full year is guided to 31.5%. Free cash flow margin guided to 35%. Q2 subscription revenue is guided to $3.815 to $3.82 billion, with non-GAAP operating margin of 26.5%.
That Q2 operating margin guidance of 26.5% versus Q1's 32% catches some eyes. The step down reflects Armis integration costs and acquisition-related charges following the April 20th closing. It is not a structural margin deterioration, it is a one-quarter absorption of deal costs. Management has been consistent about this. The long-term non-GAAP operating margin target remains in the mid-30s.
One more number worth flagging: billings growth. ServiceNow's billings grew 18.8% year-over-year in Q1, which is below the 22.1% revenue growth rate. That spread, where revenue grows faster than billings, is a leading indicator metric that the market watched closely. It does not mean the business is deteriorating, but it does mean the incoming bookings pace is running slightly behind the recognized revenue pace.
To be clear on why that matters, revenue is recognized over the life of a multi-year contract, so it lags bookings on the way up and lags on the way down. The 18.8% billings growth still represents healthy, absolute bookings volume. But with CRPO guided to decelerate to 19.5% growth in Q2, the near-term trajectory of bookings is something to watch carefully over the next 2 quarters.
What does Wall Street think about ServiceNow right now? The short answer is that the institutional community is broadly staying the course. With 31 analysts covering the stock, 27 rated a buy or strong buy, 3 have a hold, and just 1 has a sell rating. The average price target from the analyst community is approximately $155, which represents 74% upside from the current $89 price.
What is notable is that the stock is currently trading below even the most bearish analysts' price target. UBS downgraded ServiceNow to neutral with a $100 target before earnings, and the stock is now below that. When a stock trades below the lowest analyst target on the street, it indicates the market has priced in outcomes worse than any institutional analyst is modeling. That can be an overshoot, or it can be a warning that the analysts are behind the curve.
BTIG and Goldman Sachs both reiterated buy ratings following the Q1 print. Goldman kept its buy with a $175 target. BTIG reiterated buy at $185. Piper Sandler, Deutsche Bank, and TD Cowen all maintained their outperform or buy ratings, but cut price targets to the $135 to $140 range, reflecting the lower starting point for valuation rather than a deteriorating fundamental outlook.
The UBS downgrade to neutral prior to earnings was the most bearish institutional view and cited the AI seat disruption risk explicitly. the thesis that agentic AI will reduce the enterprise demand for ServiceNow's core ITSM platform. UBS's $100 target suggests approximately 12% upside from current levels, essentially a neutral risk-reward in their view. That is the institutional floor of the debate.
The earnings beat itself was clean on the metrics that matter most. Revenue $3.77 billion against $3.74 billion. Non-GAAP EPS 97 cents against 95 cents. Non-GAAP operating margin 32% against guidance of 31.5%. And critically, the guidance raise signals management has real-time visibility into the business that exceeds what was priced into the consensus estimate heading into the print.
8 consecutive quarters of non-GAAP EPS beats heading into Q1 2026, and then a 9th beat in Q1. That is a compounding track record of guided conservatism and delivery above expectations. The market's reaction, a 14% drop despite the 9th straight beat, says everything about where sentiment is right now. The fundamental performance is not the story. The AI business model debate is the story.
Let me lay out the bull case for ServiceNow, because there are real reasons why 27 of 31 analysts are still on the buy side. The first catalyst is AI monetization. ServiceNow raised its 2026 AI-specific contract value target by 50%, from $1 billion to $1.5 billion in a single quarter. The number of customers spending more than $1 million annually on AI products grew over 130% year over year. This is not future optionality. This is real revenue accelerating right now.
The second bull point is the agentic AI platform advantage. ServiceNow reports that 90% of employee IT requests are now resolved autonomously by Now Assist. Deals including 3 or more AI products grew nearly 70% year over year in Q1. The company is not waiting for the AI wave, it is riding it. And crucially, AI is not reducing what customers pay ServiceNow. It is expanding the scope of what ServiceNow does for them.
Third, the acquisitions expanding the addressable market. MoveWorks was integrated into EmployeeWorks in under 3 weeks and closed 6 deals above $1 million already. Armis brings AI-powered cybersecurity asset management into the platform, opening the $200 billion cybersecurity market to ServiceNow's distribution engine. These are not expensive growth experiments. They are additions to a proven land and expand machine that already has relationships with 85% of the Fortune 500.
Fourth, the federal government opportunity. The GSA's OneGov deal provides federal agencies a 70% discount on ServiceNow's AI-enhanced ITSM bundles. The U.S. government is one of the largest enterprise IT spenders in the world, and it is accelerating AI adoption with strict data residency requirements that favor platforms with sovereign cloud infrastructure. ServiceNow has built those capabilities specifically to capture this demand.
And fifth, the Rule of 50 compounding. ServiceNow's combined revenue growth rate plus free cash flow margin, 22% plus 44%, gives a combined score of 66. Only a handful of enterprise software companies in the world sustain that kind of profile. It means the company is funding aggressive AI investment while simultaneously generating more cash than most software companies half its size. That is the hallmark of a true platform compounder.
Now let me lay out the bear case. And there are legitimate concerns here beyond just sentiment. The most serious structural risk is AI seat compression. ServiceNow's core ITSM business is priced on a per-seat model. If Now Assist autonomously resolves 90% of IT requests, which ServiceNow is actively promoting as a selling point, why would an enterprise buy as many ITSM seats in the future? The value proposition and the pricing model may be pulling in opposite directions.
The second bear point is the geopolitical headwind. The company flagged 75 basis points of revenue impact from delayed large enterprise deals in the Middle East due to the Iran conflict. That is a real, quantified headwind for the current quarter. If the conflict escalates or spreads, that headwind expands. And large on-premise deals in sensitive geographies are exactly the kind of high-value contracts that move CRPO in meaningful increments.
Third, billings deceleration. Revenue growing at 22%, while billings grow at only 18.8%. That spread suggests that the pipeline of new bookings is not keeping pace with recognized revenue. If that continues for 2 or 3 more quarters, analysts will need to cut forward revenue estimates, and that would compress the multiple further, even if current period execution remains on track.
Fourth, valuation is still not cheap. After a 57% decline from peak, ServiceNow still trades at 49 times trailing GAAP earnings. That is a meaningful multiple to pay in an environment where high-growth software is out of favor and interest rates remain elevated. If forward estimates are revised down even modestly, the stock has further room to compress on a multiple basis before reaching what value-oriented investors would call a deep value entry point.
And fifth, the Microsoft threat is structural. Microsoft bundles Power Platform and Copilot Studio inside Microsoft 365 enterprise agreements at effectively zero marginal cost to customers. As Microsoft deepens its Agent 365 capabilities, an increasing number of enterprise IT buyers face a compelling good enough argument for consolidating onto Microsoft tooling instead of maintaining a separate ServiceNow contract. This threat is particularly acute in mid-market accounts, where the full ServiceNow platform breadth is underutilized.
Let us move to how ServiceNow stacks up against its closest peers. We are comparing 3 companies: Salesforce, Microsoft, and Workday. Each one competes with ServiceNow in some part of the enterprise workflow market.
Starting with Salesforce. Salesforce trades at a price-to-sales ratio of 3.74 times versus ServiceNow's 6.6 times. Salesforce is growing at roughly 10% annually versus ServiceNow's 22%. The discount reflects that slower growth profile, plus Salesforce's heavier exposure to front-office CRM versus ServiceNow's deep integration into back-office mission-critical operations. Both companies are selling AI agents to enterprise buyers, but Salesforce's Agentforce and ServiceNow's Now Assist are increasingly competing for the same budget.
Microsoft is the interesting outlier. Microsoft actually trades at a higher PS than ServiceNow, 9 times versus 6.6 times. But Microsoft's scale is incomparable. The company generates $300 billion in annual revenue and has a $2.76 trillion market cap. The fact that ServiceNow trades at a discount to Microsoft on PS while growing twice as fast could be read as a sign of the ServiceNow discount being overdone, or as a sign that Microsoft's bundling advantage is finally being priced into ServiceNow's multiple.
Workday is the clearest comparable on the HR workflow side. Workday trades at 3.4 times sales and is growing at 13%. Workday's PS discount versus ServiceNow, 48% cheaper on that metric, reflects its slower growth and more limited AI monetization progress. ServiceNow's premium is not just about growth rate, it is about the platform's ability to span multiple enterprise departments, while Workday remains more concentrated in HR and finance workflows.
The summary on peers. ServiceNow commands a meaningful valuation premium versus Salesforce and Workday, but that premium has compressed significantly from where it was 12 months ago. At 6.6 times sales with 22% growth, ServiceNow is closer to fairly valued than it has been since 2022. The question is whether the growth rate holds up, because the multiple is built on the assumption that it does.
One more data point on the peer comparison, the Rule of 50 score. ServiceNow's combined growth plus FCF margin score of 66 is well above Salesforce at roughly 37, Workday at roughly 38, and even Microsoft at roughly 56. On this measure, ServiceNow is the highest quality cash compounder in the group, which supports at least some premium valuation versus the peer set.
Now let us talk about what the options market is pricing in. Going into the Q1 earnings on April 22nd, the options market was positioned bullishly, a pre-earnings put-to-call ratio of 0.34, meaning call volume was running nearly 3-to-1 over put volume. Investors were positioned for a beat, not a sell-off.
Implied volatility for the April 24th expiration surged to the 95th percentile of ServiceNow's historical range. Extreme uncertainty was priced in, but the positioning was net bullish. The fact that the stock fell 14%, despite bullish options positioning and elevated implied volatility, suggests that the magnitude of the market's negative reaction surprised even bearish traders. The actual volatility realized on the event exceeded what even the expensive options priced in.
Post-earnings, the options market shifted. Put volume surged at the $85 and $80 strike prices for May and June expiry, traders positioning for a test of the 52-week low of $81. Call open interest has clustered around the $100 and $120 strikes for later in the year, consistent with the analyst community's bull case that the current price is a dislocation rather than fair value.
The options setup tells you the market is in a show-me phase. The hedging activity at 80 and 85 says traders are not willing to rule out further downside. The call positioning at 100 and above says there is real money betting the stock recovers once the AI disruption narrative is either confirmed or debunked by real data over the next 2 quarters. It is a genuine two-way market.
Now a quick look at insider activity, because this is one of the more constructive signals in the ServiceNow picture right now. CEO Bill McDermott made an open market stock purchase of approximately $3 million in Q1 2026. Open market CEO purchases, where an executive buys stock voluntarily rather than through option exercises or scheduled programs, are genuinely rare at large-cap technology companies.
To be balanced, CFO Gina Mastantuono and President of Global Customer Operations Paul Phipps executed planned sales under 10b5-1 programs totaling approximately $1.7 million combined. These are pre-scheduled sales and carry less informational weight than discretionary purchases. Net of the programmatic sales, the insider picture tilts constructive. The CEO is putting personal capital to work at $89, signaling conviction in the business at these prices.
2 buys, 15 sells in the last 6 months in terms of raw transaction count. The programmatic sales dominate by volume. But $3 million in open market CEO purchases against $1.7 million in planned program sales is a more constructive insider picture than the raw transaction count suggests.
The CEO purchase matters because McDermott is an experienced enterprise software executive who sat in the boardroom when Armis was acquired for $4 billion, when the AI ACV target was raised to $1.5 billion, and when the Q2 guidance was set. He chose to buy stock at this price with all of that information. That is a meaningful data point for investors trying to assess whether the sell-off is a buying opportunity or a valuation correction catching up with reality.
Let us bring it all together. ServiceNow is one of enterprise software's most durable platform businesses. 97% renewal rates, 7 trillion transactions processed annually, 85% of the Fortune 500 as customers, a free cash flow margin of 44%, a CEO who just bought $3 million of stock in the open market, and an AI monetization trajectory that accelerated by 50% in a single quarter.
The bear case is real. AI seat compression could challenge the per-seat pricing model, billings deceleration bears watching, and the stock at 49 times trailing GAAP earnings is still not cheap in absolute terms. But the company has navigated every prior disruption by embedding itself deeper into enterprise operations, not by standing still. The AI agents that ServiceNow now deploys are built on the same platform that has a 97% renewal rate. The question is whether that stickiness survives the AI transition.
The setup for investors right now: a best-in-class SaaS compounder with 22% revenue growth, 44% free cash flow margins, and a guide raise, trading at its lowest PS in 3 years, below its most bearish analyst's price target, with the CEO buying stock in the open market. If the AI narrative resolves in ServiceNow's favor, meaning AI expands the platform rather than cannibalizes it, this is one of the better risk-reward setups in large-cap software in some time.
And that is a very specific conditional. The risk is real, not hypothetical. UBS's bear thesis is coherent. If AI agents genuinely reduce per-seat demand, ServiceNow needs to reprice the business model before the impact hits the income statement, and pricing model transitions in enterprise software are rarely clean. The next 2 quarters of CRPO data will tell us which scenario is playing out.
So what is the single most important metric to watch going forward? Watch the CRPO growth rate in Q2 and Q3 2026. Current remaining performance obligations of $12.6 billion grew 22.5% year-over-year in Q1, strong. But Q2 guidance implies a deceleration to roughly 19.5%. A recovery back above 21% CRPO growth in Q2 would signal the Middle East deal delays were genuinely one-time. Sustained deceleration below 19% validates the bear thesis.
CRPO is ServiceNow's forward revenue visibility window. It represents contracted revenue to be recognized over the next 12 months. If that contracted backlog is growing at 22%, you can have high confidence in what the income statement looks like 12 months from now. If it decelerates materially, that is an early warning system. And for a company trading at 49 times earnings, early warnings from the leading indicators matter.
Bill McDermott closed the Q1 earnings call with a line that captures the stakes of this moment. ServiceNow is the AI-defining enterprise software company in the 21st century. We are just getting started. Whether that statement proves visionary or overstated will be answered by the next 2 quarters of CRPO and AI contract value data.
If McDermott is right, the current price at $89, 57% below the 52-week high, with analyst targets averaging more than 70% above current levels, is one of the more compelling entry points the stock has offered in years. If the AI disruption thesis prevails, the multiple has further room to compress. Either way, this is a company worth watching very closely right now.
And hey, if you want to run the same research workflow we use to build these episodes, everything is free at chargedalpha.com. 11 screening tools across stocks, ETFs, options, crypto, bonds, REITs, commodities. No sign-up, no paywall. The same data that powers this show is sitting there waiting for you to run your own screens. Check it out. Until then, I am Hudson Thomas.
This podcast is for informational and educational purposes only. Nothing discussed today constitutes a buy, sell, or hold recommendation for any security mentioned. All investments carry risk, including the risk of total loss of principal. Past performance does not guarantee future results. Always do your own research and consult with a qualified financial advisor before making any investment decisions. The hosts and producers of Charged Alpha may hold positions in securities discussed on this show. This episode was researched, written, and produced using AI-assisted tools. All data has been aggregated from publicly available sources and may contain inaccuracies. Data is current as of the recording date and may have changed.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.